Peter, let me start with you. Just a reaction that we're seeing in the markets today. Do you think it's because of some of the nerves that we're seeing regarding the inversion of the yield curve, or is it more to do with trade?
I think it's the trade issue, which is leading to economic uncertainty, which is leading to downward pressure on the yield curve. The irony, of course, is that our largest holder of U.S. treasuries outside the U.S., of course, is China. So they're making a bunch of money, right? The price of their treasuries are going up. Trade wars are not easy to win. There's tremendous offsets in terms of uncertainty. Markets don't ready. Now, for today, there's a few tells that say we're not really going to accelerate to the downside the rest of the afternoon. So if you're a trader, that might be okay. But over time, leadership has implications, and uncertainty is going to drive the market likely lower.
Achilles, if we do see the market take another leg lower, how big of a sell-off could we be talking here?
We could be seeing anything between 6 and 8%. If the trade war continues, how nasty is it going to get? Who knows? You know, but we could definitely see 6 to 8% on the downside, and there are some unique opportunities to pick up if you're bold enough to go and get them.
Peter, just going back to the inversion of the yield curve here, taking a look at the 10-year yield in regards to the 3-month, is this at all a sign that we could see a recession on the horizon? I mean, a lot of people are saying that, hey, it's a little bit too early to call for that right now. So if not, then what sign are you looking for?
So we have been calling for the potential for negative growth by the end of the second quarter, which is 6 weeks away, or early third quarter, the last time I was on here. So nothing has changed that. You know, when Humpty Dumpty comes off the shelf, right, they don't put it back together again. So the economy is slowing. It's slowing much more quickly, in our opinion, than people think. If you look beneath the surface of the first quarter GDP figures, which we have discussed previously, they are not as strong as that 3.6% growth. Could we eke out a little over 1% growth this quarter? Maybe. I'm going to short that. I think it'll be positive, but less than 1%.
Achilles, have you changed your investment strategy at all in the wake of the recent developments in regards to trade?
You know, as I mentioned before, we're looking for undervalued securities. You really have to be bold and selective in this market. But at the same time, we are looking at preferred securities, and we are looking at some utilities, depending, but we really have to be selective.
Peter, do you think that the Fed will be forced to play its hand at any point sometime soon, meaning that the Fed will actually cut rates? I mean, how likely is that to happen?
The market, if and when it drops far more than that 6 to 8%, which we're sort of in the camp. Remember, if it drops that level, we're sort of back where we were in December. But if you look beneath the surface, there are a lot of stocks that are starting to take out those lows. You look at the regional banks, that has implications for the trade war and lending to farmers, et cetera, et cetera. So yes, when the market is further down, they're going to be forced to cut. And that's just going to be validating almost the fear and uncertainty that investors have in the quality of the economic policy that's currently in place.
Achilles, Citi was out with a pretty interesting note in just regards to China's threats in withholding rare earth metals and what that could potentially mean if that could give them leverage in the trade war with the U.S. Where do you stand on that?
Well, first off, they own 70% of the market, and that's because a lot of countries won't go and do the mining that's necessary. If you look at Australia's Lynas, this company has a market share in Australia and has done over 15% just in the last month alone. But overall, we're seeing this just as another salvo in the trade war that could get nasty, and we need to be on top of it as professional managers or in this market.
If we do, in fact, see China follow through with this, Peter, is there any short-term fix when it comes to the U.S. in terms of how to deal with this?
Well, I think we all know that you should not bring a knife to a gunfight. The administration has decided to step this up. China saying, okay, here we go. We're going to arm ourselves. There is not a short-term fix because our policy thought right now, but a bit more by emotion, and those emotions are likely to exert negative pressure on the stock market. And oh, by the way, China benefits. The further the market goes, the weaker the president's hand, they benefit. So they threaten rare earth, they threaten to sell treasuries. Those things benefit China relative to U.S. economic policy.
All right, Peter Borish and Achilles Lavraya, thank you so much for joining me today.
Thank you so much.